Hi, greetings, it's me, Dr. Paul Gerhardt, and this is video number 7 of the entrepreneurship series of videos. So if you haven't watched the other videos, you might check them out. This is probably the most boring out of all the videos. I want to say I am not a CPA or an accountant. But this particular video is kind of a necessary evil because I'm going to be talking about some of the essential things that you need to know as an entrepreneur about financing and accounting. And again, I want to restate something that I always tell all of my classes is that you really got to have a good CPA. A CPA can keep you out of trouble and help you know what it is that you need to do to make sure you have a successfully profitably well set up business. So that was really kind of hard to spit out. So some of the things that I'm going to talk about, we're not going to talk specifically about accounting, but we're going to talk about accounting statements and things you need to be doing and systems that you need to be having in place. You know, you could have serious financial issues if you really don't consider some of the things that I'm going to be talking about. So I'm going to be talking about basics of funding a business. I'll give you some ideas on how to fund your business. You probably know most of these, and it could be a review, or it could be some new terms for you that I could be introducing to you so that you could become more familiar with them. Again, I highly suggest that you find a CPA to help you get started. Make sure you have a good financial software program that can help you keep track of expenses, and they're relatively easy to set up these days. Some companies actually hire a bookkeeping service to keep their books, but you still got to know what kinds of things you need to keep track of. You know, there are issues, financial issues, that your business really must be able to navigate successfully. You know, funding the firm is essential, establishing an accounting system, and then making sure you're paying the right attention to the flow of information from your business. So really, the financial accounts tell you how healthy your company is, and it gives you a way to plan things out accordingly. So some of the basics in funding a business is that a lot of people do it with their own money. And you really may need other sources of funds to get you started. It really is the number one reason why most companies fail, is they don't have the proper cash flow. And so getting started on a solid footing, there's a simple calculation that you can use to help you know what you don't know. And I'm going to walk you through that calculation in this video. And so you also need to know that there are other types of funding available for you to consider. So equity investment is something that we're going to be talking about here, and these are funds received by a business in exchange for a percentage or ownership of a business. So if you want to have an equity investment with someone or a company that does this type of thing, know that you will be giving that individual or organization a percentage of your company. And so crowdfunding is a pretty cool, relatively new thing that people are doing too. And through crowdfunding, you could receive funds by soliciting a large number of small investors via the internet. And I'll talk about some of those crowdfunding firms in this video. Non-equity funding is sources of debt, basically from banks, credit cards, asset leasing companies, individuals or suppliers, or of course you could find grants too. Sometimes you have an organization that has a specific mission, and there's grants out there, if you with the right type of research, that you could find to help get you some funding. So debt, this is a term that we probably are way too familiar with, but this is a general term that we use to describe any type of non-equity funding tied to a business. And debt is any form of capital that an infusion must be paid back with interest. And there's many different types of forms, from loans to banks or finance companies, individuals, co-funders, credit cards, and other types of suppliers. And then there are just general loans, and these are contractual agreements where a firm receives some amount of money that must be repaid over a specific period of time at a specified interest rate. So banks may provide asset-based lending, and that's a loan provided for a purchase of a necessary asset for a business. And many companies like to look to make sure that if your business went bankrupt, they could sell that type of asset and get at least some of their money back. So that's one of the things that they consider. Family member is another source, and of course you as a founder could choose to put your own money in too, knowing that hopefully you've got a good business plan and you'll get it back. So credit cards have a risk that you should consider. You've got to have, there's a repayment schedule that's going to be set up. There's going to be an upper limit that must be considered, and interest rate is something that must be considered. And some companies will loan directly to you if you are a corporate, set up as a corporation, like an LLC. We'll talk about that in another video. Credit suppliers will provide credit both on physical assets like refrigerators or equipment, and the actual supplies provided. Grants, you might be able to find government or private foundation grants if it filled some kind of need, and they do not need to be repaid. That's the cool thing about grants. So there may be grants available, and you just got to do some research on that. Equity funding, it is, you might want to have an attorney for equity funding. And it really has to do with you giving up partial ownership and profit. And you've got to be able to negotiate that very, very specifically, or you could get taken to the cleaners. And so it really is good to have an attorney available to make sure that he or she is looking after your best interests. Some other sources of equity funding are firms, venture capitalists, and then business angels. Equity investors are many types of business. Like, for instance, you may not realize, but the technology company Intel is an active equity investor, and they do it for startup firms. And so you have to consider, what would be the pros and cons of becoming a part of Intel, for instance. If you're looking to buy, it's probably the least expensive means for new ideas, products, and methods. Developing ideas in-house detracts from a core business. Investing in startups don't. Successful startups are purchased and bought into the core organization. So there are companies that are looking to buy other companies. Likewise, equity investors are sellers too, and they're always making decisions, on their best interest of their companies, and so you kind of have to think like the investor. A venture capital fund is a fund that's organized to make significant equity investments in high growth new ventures. So some companies, if you can prove that your company is going to have high growth potential, you might be able to find a venture capital fund. Business angels and crowdfunding. Business angels are usually high net worth individuals who invest in businesses, not as a business, but as an individual. And these people try to invest in things that they already know about. And it's a relatively new thing is crowdfunding. And some crowdfunding sites, write these down: Kickstarter.com, EquityNet.com, and Indiegogo.com are three of the big ones. And they've got a streamlined process that you can use as you are starting your business, and a lot of people use a video that's well produced to be able to help people understand what they're potentially going to invest in. And usually these crowdfunding sources give money as a gift, or maybe they get something in return. So that's something to be considered. Asset leasing is another financial tool, and it's tied to a particular asset by a business, and it's used to conserve cash and maintain the latest version of whatever is equitable as far as whatever equipment is available. And then factoring, accounts receivable that are sold at a discount to another company to receive immediate cash. So initial funding. To calculate the maximum amount of outside funding needed, write this down. Multiply 150% lowest ending cash balance on the cash flow statement. I know we talked about cash flow in the last video. So to calculate the maximum amount of outside funding needed, multiply 150% of the lowest ending cash balance on the cash flow statement. The resulting balance is the initial equity needed. Connect this with the percentage of the firm available to investors, and these are your investment perimeters. So, when calculating maximum outside financing, you might have a value of the firm prior to beginning operations, and that could be $100,000. The lowest point in projected cash flow might be $20,000. The required investment could be $30,000. The amount invested by the founder or you would be $10,000, could be, and the amount needed from outside investors would be $20,000. So the potential percentage of business to be expected by investors would be 20% in this case. So, the importance of proper accounting when starting a business. Most new entrepreneurs can meet their accounting needs with available software, like QuickBooks. And entrepreneurs must determine if they will use cash or accrual basis of accounting. Again, talk to your CPA. And some of the key reports you may be asked to generate include charts of accounts, petty cash register, check register, expense accounts, inventory accounts, accounts payable, and payroll. Your chart of accounts is it's kind of a fancy name, but essentially it allows you to set up your software so that each category has a number. Maybe you've got particular vendors or parts or shipping or utilities or paper or letterhead or office supplies or insurance. Each of these would have a specific number, like payroll might be 200, benefits would be 201, telephone would be 210, licenses 220, machinery 300, tools. So each of the accounts actually has a number, and so on. Let's talk about petty cash. You have to have a register for petty cash, and just let's face it, some expenses are too small to write a check. A petty cash fund operates like a savings account. The owner writes a check of X amount to petty cash, and it's kept in a lockbox with a record of the register, so you keep track about how much actual physical cash you're pulling out of it, and withdrawals are made for small purchases. When the balance lowers, the owner writes another check to bring it back up to whatever amount that you set for petty cash. So your check register is a good way for you to balance your account. So make sure that you have online banking service set up. It's not only efficient, but it's also very, very convenient. And so you can talk to your local bank about getting a banking account with an online banking service. Expense accounts, you've really got to keep daily and weekly listings of expenses, and of course this depends on the type of organization you have, and this will allow you to monthly track and ultimately annually all expenses that are made in your organization. So there's clear, transparent records, and you use your check register and your petty cash register to recall all outflows of funds. And then you've got to be able to record credit card interest as an interest expense. And also need to break payments up by credit card type, maybe MasterCard or Visa or whatever. And then you need to make sure that if you have travel expenses that you are recording these in accordance with whatever the IRS requires. So that's the big one that you have to really watch out for. So inventory account is another financial statement that you have to look at, and these include the item, the quantity, the item number, the unit cost, and total cost, and they got to match. You know, you're doing things to evaluate starting inventory, units sold, and then ending inventory, and then you're tracking your inventory ordered and your inventory received, and then you could evaluate shrinkage, which is the difference between what is sold and what is brought into the business. Accounts payable is another major financial account that you have to be aware of, and this is used to maintain a separate record for each of your creditors. All invoices should be recorded with a record of payment, including date paid and the amount that it was paid and the check number or tracking number. Payroll. This is used to maintain a record for every employee that you have, and then you need to track every check issued to the employee and list all items that make up the check: the date number, check number, number of hours worked, base pay, overtime hours worked, overtime pay rate, gross pay, taxes, benefits, and then net pay and any benefit deductions. P&L statement is something that you probably hear all the time, but that's your profit and loss statement, kind of the bottom line, and it's a financial statement that summarizes the revenues, costs, and expenses incurred during a specific period of time. And so a lot of investors are looking at your P&L statement, and essentially it's a breakdown of your total income, and all your expenses added together, and then it's the difference between income and expenses, and that will give you your profit or loss if your expenses are greater than your income. So you need to be able to make sure that you're managing your data properly, and again, you need to make sure that you keep really good records and you're doing it in a timely manner, and it allows you to be transparent if you ever get audited, which could happen, and if you need help of a bookkeeper or a CPA, which I highly recommend. All right, so I've given you some basic information that you should know as an entrepreneur. If you found this interesting or you think you can find it of value, come back and watch the video again. I hope you took something out of it, and I appreciate your time very much. And more than that, I hope that you have a great day, because only you get to choose how you feel about it. I'm Dr.